Welcome to the daily update where I'll go over the action in the market for Thursday, April 4th, and then we'll see how things look for Friday, April 5th. Had a significant down day, one of the biggest moves we've seen in quite a while. We were down over 1%. Things started off pretty well, but then a non-voting Fed member came out and made some comments that the market didn't like, and that reversed everything, and we headed lower. Now, for right now, we are still positive, but instead of dealing with the 20-period moving averages, we're dropping down and possibly dealing with the 50-period moving averages. The market may have become a little too comfortable with this latest scenario that the Fed's automatically going to lower rates, even though we've been seeing stronger than expected economic reports and inflation that isn't going down as nicely as it was before. The markets had pretty much thrown that off. It's like, well, we don't care what happens. The Fed already says they're going to come out and cut rates 3 times. Well, that's being really put into question right now. And that's what the market likes. It doesn't like to be taken for granted. It likes to climb a wall of worry. And just about the time everybody thinks it's going to go back up, that's when it will go up for a while just to suck a few people in and then turn around and go down. Now, we can still recover from this. We're still looking positive. Our longer term charts are still intact, but it's putting some real apprehension in the short to intermediate term right now to say, okay, are we going to get even weaker from here, or are we going to be able to bounce and go back higher from this point? Now, we have probably the biggest economic report of the month coming out in Friday's session, the employment situation report. We'll see if that can shed some light on what the market is going to do. Is it going to be a solid report or a weaker report, or is it going to be a mixed report and kind of leave the markets a little bit more confused rather than having any kind of conviction? Before I get started, just a couple of notes. There are 2 videos now that go over the proposed program that I'm hoping to launch in June. I also have a lot of different ideas and things. I may be putting together a video at some point down the road just because I want to get some feedback. Those of you that have been watching the videos, those of you that have expressed an interest in being involved in the program. I've been an educator for a long time, but a lot of the ideas that I implement actually are from feedback. So nothing that major, just an opportunity for you to voice some things if you want to do that. But that might be a week or 2 down the road before I actually put that together. Also know that the daily video, the video that you're watching right now, that's only one of many videos that I post each week. Here's the whole list right here. And if I was to pick out the most important video, it would be the daily video. The most popular one right now is the What to Watch video. I include everything in the daily video that I cover in the What to Watch video, but there's more context. And yeah, my videos are longer. Yeah, if you want to have good information, it's going to take a little bit longer time to analyze things. But then there's other videos that I do that try to give us a big picture look at what's going on in the market overall. Also, please know that if you put a comment either on Rumble or YouTube and you're not a marketer, or it's not some kind of a crap comment, I will always respond to that. But if you respond to my response, then I'm not always in fact, I'm not notified about that, and it could take me a while to get back to that. Please know that at the end of this video, I do give you an email address where if you want to contact me directly, you're more than welcome to do that. Let's go back and talk about what happened right at the open. Things were looking mighty rosy to start off with. We had a gap higher open at R2 at 52.46. Prices kept going up, but we struggled to stay above the 52.50 level. But it was like, okay, maybe we'll just fall back, regroup a little bit, and then get set to go higher. Well, that's not what happened. Prices ended up reversing and fell down below R2, R1 at 52.29. Then we went negative. We fell below the unchanged level, the daily pivot at 52.12. We fell below S1 at 51.94. and it should be S2 at 51.77. We tried to find support right around the 51.50. We're back to that crazy Van Halen level again, and we closed at the intraday low. We were down 1.23%. Not big in and of itself, but compared to the moves that we've been seeing lately, this is a pretty substantial move. And volume, for the first time in quite a while, was actually above average. So we saw a lot of selling. We've been below average with volume lately. We have a solid down day, and volume picks up. The perma bears are really honing in on that one. We'll have to see. Was this just a reaction, and will we be able to bounce from this? The technicals, we're still positive, but we're really showing some weakness right now. There are some negatives that we're going through, and I'll go through those charts. But when you look at the bigger picture of what's happening right now, this is a pullback. And now, as I've been saying all along in these videos, we'll just keep evaluating things. Now we're seeing a little bit more intensity, and this is actually turning into a decline. Is it going to actually develop now into a correction? We don't know that at this point. We can just go with what we're seeing right now. And it's about inflation and interest rates. And I'll go through a little bit of what happened there. And then geopolitically, we've got some real things happening in the Middle East, specifically in Israel, and then tensions between Iran and Israel and the whole region. That's pushing oil prices up. And because oil's going up for that reason, that's pressuring stocks as well. And just a real unsettledness right now. Some comments. This is Fed President Kashkari from Minneapolis, and who's not even a member, a voting member anymore, said that it's possible that the Fed might not cut rates this year if progress on inflation stalls. We've had CPI, PPI come out. We've had the ISM non-manufacturing. Those reports were strong. No, I'm sorry, manufacturing. Those reports were stronger than expected and not really leading itself to interest rates going lower. But the market was kind of ignoring that, saying, but we've heard it on good authority from Chairperson Powell that it looks like rates are going to be cut. Well, then this person, who's not even a voter any longer, but is still really influential, comes out and says, that's not a given. If these economic reports come in stronger than expected and inflation doesn't keep falling, or it actually starts to go back up, that whole scenario could be in doubt. And there's increased geopolitical tensions in the Middle East, specifically between Iran and Israel. Oil keeps going up, and that's going to be inflationary. It's at $86.57 a barrel. And all 11 sectors in the S&P declined. The S&P has now dropped below its 20-period moving averages. We've been watching that, and that level had been holding. Well, it's not holding right now. And on a short-term basis, we only have the stochastics, and we only have our long-term stochastics chart, and that can take a while to actually switch over. But other than that, we're no longer extreme positive, and we're even getting a little bit longer list now of extreme negative readings. The VIX is it's actually going up pretty fast as stocks are really going down. I use an RSI based on 9 periods to measure the speed, and that's getting extreme positive, which, again, that's because stocks are going down. The Stoch RSI, the Force Index, that's a pretty touchy indicator as well. And we're seeing the S&P 500 McClellan oscillator, it's dropping down below 30. It's starting to give us a pretty extreme negative reading. Long term, though, we're still extreme positive when we look at the 150 and 200 period simple moving averages. The parabolic SAR is negative, and we have another list or things that are added to the list of negative things. The thing that is really in question right now is this scenario that we've been dealing with, that it looks like the Fed's done raising rates, and they're probably going to cut rates 3 times. Well, with the comments that came out on Thursday, that could really be in question right now. The dollar was down and interest rates were down. Now, these were 2 things that could have supported stocks, and they did kind of right off the bat. But everything just shifted later on in the day. We closed at 4.31% for the 10-year yield. The yield curves that we do follow are still inverted. Sentiment, actually, this should be more neutral. I should have changed that from positive to neutral. We were at 62. We dropped all the way down to 49, and we're tipping below 50. So we're even looking a little bit negative there. Our trend is now negative, and the ADX is weakening. We're seeing the red line coming up above the green line. We're below the moving average, so it's a weakening trend, but we're still above 20, so we are in a trend. With the down day, solid down day, the bias is negative. That's usually one, whether we're up or down for the day. The momentum, I'm still keeping it mixed to negative. We could bounce from where we're at right now. It's not a given. Doesn't automatically mean that's going to happen. It's probably going to be what's the market going to do in reaction to the employment situation report. If we can get a solid bounce out of that, we could turn the picture back more positive. The market doesn't like that, or we don't get anything to really give us some clear insight as to what's happening, we might see more selling. Economic reports that came out, this was actually a little bit more market friendly in that the weekly jobless claims were greater than expected at 221,000, more than the 214,000 that they thought were going to come out. That's just showing the employment situation is a little bit weaker on a more of a leading indicator. And continuing jobless claims are at 1.791 million. The trade deficit, which is always negative, came in at a minus 68.9 billion. And that was more than the minus 66 billion that they thought. Last time it was at a minus 67.6 billion. Here are some charts. Here are the weekly jobless claims, where the black line, that's the week in, week out number. That's spiking up, and we're seeing the moving average turning back up. That's suggesting a little bit of weakness in the employment situation. And continuing claims continue to decline. That's the black line going down, and the moving average is flattening out just a little bit. So even though people might be unemployed, it looks like for right now, they're only unemployed for a week or so. Here's looking at the initial jobless claims, which are in red. Then in blue are the continuing claims and the latest reading on the unemployment rate. And that's going to be updated in Friday's session. We're currently at 3.9%. Is that going to go up or down with the employment situation report? And this is more of a blow up of that same chart, just to give you a better look of how things are moving. When we look at the trade balance, and this is a 3-month average in billions, where it is coming down, but it's always negative. We're always bringing in more than what we're sending out. And here's imports and exports on a year-over-year basis, where they're both going up currently. The trade deficit is negative. And then here's some charts from Isabel Net. This is just looking at the PE multiple. We have the 10 largest stocks. Right now, we're coming in at about 26 times earnings, which is considered to be expensive. When you take out those 10 big stocks, we're at about 19. And every day I show you different. Now, this does change every day, but not as drastically as what we've seen, because I was showing a different chart in yesterday's video that's quite a bit different than this. But and you can, that's the thing about numbers. You can pretty much turn them around and have them say what you want them to say. And I actually took classes on that as a math teacher. You can take a set of data and say, okay, take this data and give us a negative picture. Now take that same data and give us a positive picture, and you can do it. It is possible. All right. Then looking at the consensus earnings per share, where the Magnificent Seven, they're kind of leveling out here, but they're really leading the pack. And then we have the S&P 500 itself, and then the rest of the S&P down below, showing that the rest of the company's earnings per share going forward are lagging right now. And then looking at the equal weight S&P PE model, whether we're over under valuation model, we're getting a bit overvalued right now. We could go higher than where we're at, but this has been going up as stocks have been going up, meaning that we could be getting closer to the expensive side of things. And then this is kind of what sparked everybody in the markets to freak out. Fed's Kashkari floats possibility of no rate cuts this year. Not even a voter. This is what he looks like if you want to put his picture up and throw darts at it or something. But yeah, he's just saying what's really happening for right now. We're looking at this cycles chart, not knowing if there's anything really behind this or not. We could be into one of the down phases now as far as the cycles are concerned. And then here's our chart where we were looking really good right off the bat. We gapped higher at R2. In fact, I was starting to break out the pivot point calculator and say, okay, what is R3 going to be at? Because we had a shot at actually going higher, but then we started to drift down. We got up to around this 4260 level or so and just couldn't stay above it, and started off a little bit weaker, and then pow, everything just kicked into gear. Down below S1, we went negative. Sorry, R1. Then we fell below S1, S2, and closed at the low for the session. Here's the intraday chart where it was looking a lot better before the market opened. And for the first little while the market was open, it was looking really good. And then everything just fell apart after that. And even though both growth and value were down, the blue line is still above the red line. So we're possibly shifting back to that now, where we want to keep more of an attention on the growth to value ratios if inflation is going to be coming in and being a little bit more of a problem. But both ended up being down on the intraday chart. We're also seeing the growth to value ratio for the S&P going back down again. Here's our end of day chart where growth was down more than value for the large caps. They were about even with the mid caps and about even with the small caps. And this is giving us some concern too. The small cap growth to value ratio, it's starting to decline. We're also seeing a decline with the mid caps, and we're seeing a decline with the S&P 500. We're also seeing a decline here when we compare discretionary with staples. But large cap growth, when you take it all by itself, yeah, it was down 1.4%, but we haven't even come back down here to any of the moving averages yet. Now, this is longer term. So this blue line is a 50-period moving average. And yeah, we're seeing some weakness here, but we've seen weakness before, and we've been able to bounce up from that. This is also times when we've seen weakness only to be followed by more weakness. Looking at our trend where we're crossing now, we're seeing the red line crossing above the green line. That means we default to negative for right now. But the ADX continues to decline. It's below its moving average. So this is a weakening trend. If this keeps going down, it's going to fall below 20. That means that we will be in a trendless environment, but we're not there yet. We're also getting really close here with the ADX. We actually have slipped into an almost trendless environment with the ADX in the short term, but the red line is crossing above the green line, so we are turning negative. We did see a turn up with volume, but this is continuing to be below zero because the last number of trading days have been below average with volume. Sentiment, this is a reading that came out. It was updated on the 2nd of April, and we're still above 4. And this is one of the reasons we were getting nervous about the market. Folks were getting a little too complacent. They were starting to really just assume that prices were going to go up. And they used this whole buy the dip mentality. Well, that might work when it works, and it doesn't work when it doesn't work. And that's why I'm not a buy the dip kind of person. We came down to the 20-period moving averages. People started to buy. Well, now we're possibly dealing with the 50-period moving averages and a whole lot of folks that are suddenly seeing some losses they weren't really expecting. This is also showing that fear is really increasing. We went up with the VIX on the line chart and getting a lot higher reading than we've had for quite a while. In fact, the highest reading now of 2024. Don't you just love it when you use those comparisons? Oh, that's a closing value. We got a little bit higher here back in February, but the bar chart of the VIX also picked back up. With the down day, we're seeing the VIX of the VIX, or the volatility of the VIX, really picking up, both with the bar chart and the line chart. We had come down to some really low readings where we were just not seeing a lot of volatility. Well, that is usually ripe for some kind of a pullback. And as stocks are now going down, we're seeing this reading going back up. Here's the VIX looking at an RSI based on 9 periods, and we are extreme positive. We don't see these readings all that often, but this just means that the VIX went up really fast. The MACD has now turned back up. We had been seeing a general downward momentum with the VIX. Now that the VIX is starting to go back up, we're seeing the momentum going back up. And here's our equity put call ratio, where we are turning back up based on 5 periods. And I have these charts in reverse, where we actually declined just a little bit with the equity put call ratio here. It's kind of strange to have a down day. These charts have been kind of weird lately here. The volatility risk premium, we're starting to get rather extreme. We could still go higher than this, but this is just meaning there's a real increase in fear. Then looking at another version of equity risk premium, the framework, where, okay, this was getting quite low over here. Well, we're starting to spike up. And so this chart is even out of date from when I found it at Isabel Net. We did get the latest reading of the American Association of Individual Investors. They're still positive, but not necessarily extreme positive. And then looking at our advanced decline line studies, we did decline based on price and volume. We're keeping an eye on volume right now because even with the last couple of down days, volume seems to be hanging in there a little bit better. When we look at the new highs, new lows, with the gap higher, we saw an expansion of new highs and not really an expansion of new lows. We're trailing off just a little bit with our 5 period, and we're declining with our 10 period moving average. We're dropping in the short term below 0 with the advanced decline ratio. That's the 19-day exponential moving average. The red line is 39 periods, and it's declining, but still above 0. Accumulation distribution. This was showing some improvement. We were slightly above the moving average. Now with the down day, we're below the moving average. This is kind of sneaky here. The Chaikin money flow is actually turning back positive. So this is something that we can latch onto. This is a smart money indicator, and it's also based on volume. So to see this turning back up over the last couple of days when we've seen a decline, that could give the market some hope. Chaikin oscillator also crossing back above the midpoint and turning positive. But when we look at our advanced decline line studies, we're pretty much declining across the board, with the small caps being the weakest, coming back down to their moving average. Here's the daily chart where we broke below this pivot point here. Now it looks like we could come down and possibly test the 50-period moving average. But it's the 50-period moving average in the NASDAQ 100 that we're really watching right now, because we're hitting that right about now too. This is the one-day rate of change, just going from Wednesday to Thursday. We might have overdone it since this is a bigger move than what we've been seeing lately. Stoke RSI, after being extreme positive, we have a down day. It's now remaining extreme negative. We did finally drop below the 20-period moving average. Now, we've done that before, not so much in 2024, but there could be a bounce from this. But for right now, this support level has been lost. And we're dropping below this little mini rainbow with our other 20-period simple moving average study based on the open, high, low, and close. So the shorter term is being threatened right now. Now we're looking at the 50-period moving average. We're still above both of the lines for right now, and there's still a ways to go. It would be a drop below 5,100 before we would even start to approach the 50-day moving averages. The Bollinger Bands, we're dropping below the midpoint right now, so that's turning more negative. And we're coming down with our 20-period double and triple exponential moving averages. We're falling below these lines further than what we've been since the early part of the year. We're no longer extreme, and now we're declining with the 20, 50, and 200-period moving average study. We're below 0, and we're actually getting extreme negative with the force index. We're hitting the lower Keltner band. We're not extreme in the short or intermediate term. We're actually negative in the short term, declining in the intermediate term, still extreme in the long term, but rolling over. If we drop below this line, that would take the stochastics chart off the extreme positive side. We're also dropping below the midpoint, and we're down in the -1 channel for the standard deviations chart, and we're just about on the border with the -2 standard deviations channel. Intermediate term, we are looking a little more negative and turning down with the balance of power. The go, no-go system is still a lighter shade of blue, so that's turning more negative. We're dropping below the midpoint with our highest high value chart. We're turning more negative here and declining with the TTM squeeze, the 50-period double and triple exponential moving average. really coming down, starting to see the lines roll over ever so slightly. Ease of movement actually was up a little bit and is still positive. The Erin has not changed and is still positive since we're above zero with the oscillator. This is where we're starting to get extreme negative with the S&P McClellan oscillator. I think I said below 30. It's actually down below minus 60. So we are now headed down with the summation index based on price and volume. And we're negative here with the NYSE McClellan oscillator, but not extreme negative. And so we're starting to turn down with the broad market with the NYSE summation index based on price, a little bit less of a decline here based on volume. And this is also showing that volume is holding up a little better for right now. The Swenlin trading oscillator based on price is now turned negative and dropping below zero, where we're not dropping quite as much based on volume. We're starting to go a little bit more negative now with our oscillators. We're turning down with the PMO based on price. We are negative. We're rolling over and just crossing the moving average based on volume. We're almost extreme negative with the PMOs that are rising. We're coming down to this red line. The buy signals are declining. We're rolling over with the PMOs that are above zero and still a little bit extreme positive. We've turned over to negative with the Elder's Impulse system for the S&P. We continue to be negative with the parabolic SAR. The slope oscillator is rolling over after just flatlining at this extreme positive reading. So that's turning a little more negative. We're also looking more negative with the MACD. So all of our oscillators, the short and intermediate term, we're rolling over. Also seeing a bit of a rollover with our longer term oscillators, the TRIX and the KST. We dropped below the 20-period moving average here in our moving average tree, and we're below 70 with the bullish percent index. This is now a sell signal. Now, we could still recover from that, but it's going to turn more negative if we end up going all the way down to 50. Holding up a little bit better with the NYSE bullish percent index and didn't see much of a decline there. We're turning negative here with the NASDAQ 100 bullish percent index. We've dropped below 50. We were flat, but we're below 50 with the money flow index, and we're declining and below 50 with the ultimate oscillator. We dropped below this one level here with the vortex. We're still positive because the green line's on top, but it's really been showing some weakness. And we're just about at the midpoint with our RSI 14. We're actually turning more negative with the RSI 9. We don't see many readings underneath 50 going back to about the early part of November. Still positive with the on-balance volume. In the 20-period moving average study, we're dropping below 50%. So this was more broad-based, at least as far as the S&P is concerned, with the decline. We're also declining with the 50-period moving average study and still looking good longer term, but now rolling over with our 100-period moving average study and our 200-period moving average study. Topic curve is looking a little more negative now. The Sean trend meter is no longer extreme positive and now declining. I wanted to put this on here. We're going back to the all-time high and measuring the Fibonacci retracement levels. If we just really scream, this is the 38.2% retracement level. That would still be quite a significant drop from where we're at now. We're looking more negative with the Heiken Ashi, so our trend is switching back a little bit here. We're negative with the Kegi chart. We're red and pointing down. Renko, it redrew again and is still looking positive, where the three-line break is looking more negative. And we're coming back down. We're at 5147. This R1 level that was quite important on the weekly chart of the S&P, we're about, 35 points away from that now. So if we see more of a decline, is this going to provide support? If not, that could turn things more negative if we fall through this level. We're still extreme positive, but declining from being extreme with the 150 and 200 period moving averages. And we're seeing a little bit more negativity. The S&P on a short-term basis is now turned negative. The small caps and the NASDAQ 100 are also negative short-term. Looking across the different markets, stocks are now negative in the short term. Bonds are negative across all time frames. Commodities continue to be negative in the long term. And we started off by seeing, and we read this from the bottom up. So the day started off all just nice and happy. And then everything turned to red later on as the day played out. The equal weight also going down with the S&P 500 weighted index. Didn't see much of a change here. We declined a little bit as the large caps underperformed slightly from the equal weight index. We've dropped below the 50-period moving average with the Dow. So that has now been taken out. We're turning negative with the diamonds. When looking at the Elder's Impulse system, we're still above the 50-period moving average with the NASDAQ, and we still have this S1 level below current price that may provide support. We're seeing the moving average and the support level converging with each other. This is the one that we're watching right now. We're right at the 50-period moving average for the NASDAQ 100. Are we going to be able to bounce up off of that? We also have a support level right at that level as well. The Qs have now switched and they're looking they've actually been negative for a few days. They're even more negative right now. The momentum for the NASDAQ 100 is negative. And here's the this is the 50-period moving average. Now with the QQQs, we closed right on that. On the negative side, we fell. On the positive side, for right now, this moving average is providing support. And there's a lot of carryover between the NASDAQ 100 and the S&P 500. The employment report comes in, the market likes it. We get a bounce up off of this. That could really help things. The report comes out, we see more selling, we drop below this, that could turn things more negative. Small caps, of course, they had to be down. They were down 0.87%, and we're coming back into this range that we've been in. We continue to be negative with the Elder's Impulse system for the small caps. We're still above the 50-period moving average with the Russell 2000 small caps, but we're dropping below 50 with the RSI. Longer term, we're still in an uptrend. We're now turning back to negative with the momentum. The mid caps also drop below this pivot point, but still above their 50-day moving average. And the mid caps have gone from being neutral over to negative with the Elder's Impulse system. Apple ended up being down 0.5% and is in a downtrend. Tesla was actually up over 1.5%, but is also still in a downtrend. Google, after setting a couple of all-time highs, really saw some profit taking and has dropped back down, but it's still looking positive. Then Nvidia was down almost 3.5% after it's been going sideways after setting recent all-time highs. The FANG index now coming down a little bit more into the sideways range that we've been in. Financial sector was down, but still in an uptrend. The dollar continues to show a little bit more of a bounce. We're into the 104 range here, even though it did decline slightly on Thursday. And then looking at the divergences between stocks and the dollar here, and this is when I say in the videos that the market tends to like a weaker dollar. So they inverted this, where we look at the S&P 500 as it's been going up. And then as the dollar's been going down, that's been helping stocks. Now, if we're seeing some more strength in the stocks or in the dollar, that could put some more pressure on stocks. Then oil, this is also a cause for concern because of the context. Now, if oil was going up because the oil companies were making more money, the stock market would love that, but it's going up because there's tensions in the Middle East, and the market doesn't like that. So we're getting up into the 86 range now. Then looking at the S&P 500, that's the red line here, which declined, and comparing it with the rest of the world, which was actually up, we're seeing the 10-period correlation decline after it had been improving. We're flattening out and starting to decline with the 50-period correlation. We were down with the 10-year yield, but that didn't give any support to stocks on Thursday. We were up with the 10-year based on price. And then growth to value, not really showing any strength right now. We're declining with the Qs to S&P ratio, the discretionary to S&P. Large cap growth is underperforming large cap value. So with the large caps, mid caps, and small caps, we're still under the moving averages. I haven't shown this in a while, where we're starting to drop below zero with our 19-day exponential moving average of the advanced decline ratio. The chart that I showed earlier on with the blue line and the red line, and the blue line's dropping below zero, that's the same measurement that we're seeing right here. And since we're dropping below zero, that's turning things a little bit more negative in the short term. But we haven't, and that's based on price, but we haven't dropped below zero yet based on volume. So what's our outlook for Friday? There's going to be this total solar eclipse on Monday. Is that even going to be relevant? We're still positive. And for right now, believe it or not, it still looks like this could be a pullback. We're getting to that point now, the tipping point, where if we drop below the 50-period moving averages, that could turn things more negative. There's still weakness that's starting to come into the market. And this is incorrect. We're going to get the employment situation report on Friday. And then all the geopolitical events, the market right now is focused on oil because of what's happening between Israel and Iran and the whole Middle East situation right now. Here's the employment situation report. And then I don't know why I didn't update this for some reason, but these are the economic reports coming out in Friday's session. Seasonality, we're neutral to negative on April 5th, and we're just flat out negative with the NASDAQ. But it's like we've been doing the opposite of whatever seasonality is these days, so maybe this will end up being positive for the market. Then we will be on the 5th trading day, where we do see a little bit of negative seasonality with the green dashed line during an election year. Not sure where we're at right now as far as our seasonal patterns. But here's what April ends up looking like. It doesn't mean that we're always going up here, but we might see a little bit of a historical bounce right around now. And then looking at another seasonality from 1976 to 2023, here's the year to date, just showing that we've just skyrocketed above all these other seasonal patterns, whether it's an election year or not an election year. And April does tend to be more of it's the last positive month, according to the Stock Traders Almanac research. Friday is one of the more positive days. If we compare to what happened in 2023, April is one of the stronger months. Then we're up 11 out of 18 times for the S&P, down 7 out of 18 times. Then when you take everything together, we're up 71.6% of the time with an average return of about 1.5%. The warning signs, the equity put call ratio is going up. When we look at it based on 5 periods, the parabolic SAR is negative. The bullish percent index is now dropped below 70, and the McClellan oscillators dropped below 30. The bullish percent index is dropped below 50 for the NASDAQ 100. So we're seeing some weakness now. The money flow index is negative. The ultimate oscillator is negative. The Copic curve is negative. Small, mid, and large cap growth to value ratios are weakening. And then we have these negative divergences, which may be coming into play now when we look at our oscillators. The small caps continue to lag. Discretionary to staples, that ratio is just not performing all that well right now, even though it's still in a longer-term uptrend. And the transports to the Dow and S&P, and the momentum for the NASDAQ 100 is still negative. On the positive side, and this is kind of lurking in the background, the Chaikin money flow and the Chaikin oscillator are turning positive. Vortex, it's still positive, but has been weakening and is just trailing off, going lower. Large cap growth for right now is holding up, but it's been pulling back a little bit and underperforming. The financial sector was down, but is still in an uptrend. So our conclusion, we're positive. Right now, it's still looking like a pullback, could possibly turn into more of a decline. Weakness is developing. We're wondering, is the 50-period moving average, whether it's the NASDAQ 100, which we're at right now, or for the S&P 500, which we still have a ways to get to, is that moving average going to provide some support? In the short term, it still looks like we're pulling back as weakness is developing. In the intermediate term, also, we're seeing some weakness, and we want to keep an eye if we really start to fall, that 5110 to 5111 level. Will that area end up providing support? Long term, we're still positive, and we're still overbought because our 150 and 200 moving averages are above or looking extreme positive. Thank you. I really hope you found this helpful. Have a very good day. It'll hopefully be kind of exciting to watch things on Friday, and I will talk to you in the next video.